Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
All right. What really are the benefits of fundamental analysis? Why do this stuff? I guess is the question I'm asked, because everybody has a technical charting package and all the news is in the price, that type of thing, which we don't necessarily disagree with. But let me try and go through this and tell you why and justify why we think the fundamentals are so important. Number one, it really lets you understand the consensus view. And that's important. You got to understand, in order to evaluate price action going forward, you have to have some type of base. And without the fundamental analysis, understanding the key themes, the key drivers that are in the market that are driving the current consensus view, you're not going to be able to really make some sense of the price action. For example, right away, if you know the consensus view is for a very, very weak dollar, very, let's say poor GDP or jobs or whatever, there could be a multitude of things. But in general, the consensus view is for a weak dollar based on these ongoing fundamentals. And all of a sudden, the price action starts to diverge from the consensus view. It's important, one, to understand that it is converging from the consensus view, but it's also extremely important to have a plausible alternative scenario to try and make some sense of the divergence of price action against the consensus. And I think that's what fundamental analysis done right helps you do. When you do fundamental analysis, your first job is to try and understand what the consensus thinks and watch how reality plays out against that. Because just knowing that and seeing a surprise in price action or a surprise in the news, you know something's going to happen because you know how the consensus is positioned. Number two, where we found the biggest bang for the buck in fundamental analysis is this idea of developing plausible alternative scenarios. Couple things that does for you. Number one, it keeps you very, very open and flexible. We've all been in a situation where we've made a trade because of our fundamental view, or it can be technical also, but we've made a trade because our view was so strong and we were so confident. But what happens when we make a trade on one view, we tend to negate the negative information that's coming in from the market and only look for information that validates our view. By developing a plausible alternative scenario based on the fundamentals, right away that in and of itself keeps you open, because your decision process when you put a trade on should be something like this. Okay, I have enough confidence in this view to put a trade on and pull the trigger. Instead of saying, okay, how much money now am I going to make, how much I'm going to make, your next decision should be, what information is coming from the market to invalidate the reason I put this trade on? And by building plausible alternative fundamental scenarios for intermediate and long-term views, it allows you to be open and flexible to that, what would be negative information to your existing position. But at the same time, as this information comes in, hey, maybe it's starting to validate exactly that plausible alternative scenario. So maybe I want to take some of the position off the table and start to position the other way against the crowd. Because when the surprise comes in and that consensus is surprised, that's when we see the biggest moves in any market, and especially currencies. Currencies move differently than stocks and bonds in that they are so consensus driven. So they get into these self-reinforcing price trends because everybody seems to have, gets crystallized on a certain view in currencies, because there's a lot of stuff going on in the world that they either don't understand or they miss. But one particular scenario starts to build, and therefore we get these self-reinforcing trends. You're watching that. You're watching these trends that reinforce the consensus, and all of a sudden the price action isn't reinforcing the consensus. Maybe it's starting to reinforce your plausible alternative scenario against the consensus. You start to position in the other way. It really is that simple, and those have been some of the best trade setups we've ever had, just using that simple analysis right there. Price action has to continue to confirm the consensus, or there's something else going on. When doing fundamental analysis, you always have to keep in mind, a couple key things. Number one, over time, the fundamentals really are ultimately the drivers of all things in the markets, and I think we should all understand that. The fundamentals ultimately are drivers. And when I say the fundamentals, it's not necessarily the fundamentals, but it's the perceived fundamentals or the reaction to the perceived fundamentals in the market. There's so much going on in the complex economy of the world and a lot going on under the surface, and I'll get to that on the next slide, that these rationales develop on the top side. So even though we may have a perceived rationale that may be wrong, if the consensus is tied into it, it doesn't matter. But there's where your alternative scenario comes. And an example is right now. Right now in the currency markets, most people believe that the dollar is going to fade again back into a bear market. It's going to lose its reserve currency status longer term. China is going to continue to grow as far as the eye can see. The stimulus is working, all those types of things. And that's a view that's been right for the last couple of months. But we happen to have a very strong plausible alternative. Actually, it's not plausible alternative view. We're starting to play it as our most confident view, and I'll get into that later and show you exactly what our key views are. But we're positioning against that trend a bit, because if we are right and the consensus is wrong, and the information in our fundamental analysis is building to support a view that's slightly different from the consensus, we know we're going to make a bunch of money for our clients. And this is a very interesting, a very clear case of one of these views playing out very, very strongly in here in a big breakout move, either to the downside or upside in the dollar. So as I go through later, I think you'll understand why the fundamentals, thinking in terms of fundamentals, are so important here, and I hope that made some sense. I rambled there, but you also have to remember the capital flow is the key. We're never going to understand, as I said, all the fundamental drivers in the market. Ultimately, capital flow trumps whatever goes on, and I'll show you more in the next slide, and explain that in more detail. Also, keep in mind, fundamentals can be very short-lived. They're ephemeral. They can go away, and often the fundamentals can be impacted as much by price and as prices are impacted by fundamentals. There's a constant feedback loop of fundamentals and price in all asset markets, again, especially in currencies, because they're sentiment driven, because people latch on to particular fundamentals that they think or perceive are driving it. So if the price validates them, therefore their fundamental view is right. And the price keeps validating them, their fundamental view is right, and this view becomes stronger and stronger and stronger, and that price validation creates that self-reinforcing trend until people start to realize that they were completely wrong, and that's why you see currencies tending to overshoot and undershoot. People get the fundamentals wrong for a lot longer in these markets than they get them wrong in other markets, because they build self-reinforcing trends based on those fundamentals. That's a good thing if you're riding the trend, and it also can be a good thing if you can start to look the other way and say at a certain point the fundamentals are so out of whack with the price action here that I either want to take something off here or I want to actually start to position in the other direction. And there's, and that comes about on a regular basis in many, many time frames in the currency markets. You saw it in the dollar last year when everybody was extremely bearish on the dollar for all the reasons: current account deficit, China, money flow into all the emerging markets, on and on and on, to superstars wanting to be paid in euros and rap singers wanting to be paid in euros, all those types of things, and the magazine covers the dollar going down in flames on the front of the Economist. You get those things when you get these major misalignments in the fundamentals, and that was a major one. If you looked at the fundamentals, the euro was about 33% overvalued against the U.S. dollar when it hit that 160 range, and that's a massive overvaluation on a purchasing power parity basis. But it was an example of fundamentals getting very, very out of line. So it's something, again, to understand. If you understand what the fundamentals are, then you'll understand how out of line currencies can be or are at a point in time. And that in itself is another great piece of information from a trading standpoint, because once the fundamentals get way out of whack, then you start to look at your technicals and look at price action. As price action continue to confirm this incredible disunity between the fundamental analysis and the price, and there's where your technicals can start to come into play in your intermarket stuff.
Thank you for listening to our podcast.